Yo, what's up everybody? Tuesday, August 3rd. Hey, did you miss me? I'm back. Took a couple of days, went out to Idaho, doing some whitewater rafting and some bass fishing. Took my son for his 21st birthday. We went to this little town called Riggins, Idaho. Population 400, right on the banks of the Salmon River. And let me tell you something, it was awesome. It was fantastic. We had a great time, caught bass, rode the whitewater, did some hiking. Awesome. Sometimes you got to get away, clear the head. But anyway, as I mentioned here in a comment, in a reply to a comment, I was sending out emails. And you know, we were in an area that did not have the greatest had no cell phone connection and very little Wi-Fi connection. Anyway, let's talk about the markets. You know, a couple of things here. I said before going away, you know, I had been cautious, and then I said, look, two things. Number one, the Fed has created a Goldilocks scenario for stocks, and that was as a result of those reverse repos. The Fed had been alleviating the pressure on the banks from all the massive reserve additions by sweeping that cash off and holding it on its books. I was talking about that over several days, and I said, look, the market's going to go higher. I also said that we will probably see banks now start to accumulate more trading assets, and that's exactly what has happened. If you look at the most recent banking data, the H8 Fed release that comes out every Friday, you know, the last 2 weeks, a big increase in trading assets. All right, so I said that was going to happen. That happened. I said trading assets and the accumulation of those assets by the banks. And what are trading assets? They're basically like derivatives. They could be equities derivatives. They could be foreign exchange derivatives, you know, interest rate derivatives. You know, the banks also can speculate in those things, and they've been doing it. And I said that's going to drive the market up. The other thing is sentiment. I mean, we still have a very elevated level of people who are neutral. They're on the fence. And I think that's a key thing. I think you got to get those people off the fence. Now, neutrals have been high for a while. They dipped down for like 1 or 2 weeks, but people are right back on the fence again. And I think that ultimately you're going to see those neutrals jump off into the bullish camp. The other thing, institutional asset managers, when you look at their position in S&P futures, okay, the E-minis, still, I mean, despite this gigantic, unprecedented, historic move that we had since last April 2020, from the bottom all the way up to where we are right now, institutional asset managers have never even come close to their long commitment that they had in February 2020, when they were, you know, net long something like 1.1 million futures contracts. Net long, of course, meaning net longs minus shorts. I mean, the most they got up to was like 970,000 recently, and then now they're back down to like, you know, well below that. So I mean, to me, that's just another indicator that they're not fully committed to this rally. But here's the thing I want to talk about today, all right? Because a friend of mine sent me an article from that goofy blog, Zero Hedge. There are some things in Zero Hedge that I can appreciate. And the main thing is that they tend to scoop other major news outlets, you know, well in advance. I don't know how they do that, but they do it. But anyway, there was an article about some hedge fund, I think it was a $12 billion hedge fund, that took a $1.5 billion shellacking loss because they were short Treasuries. Now, again, I don't know how many times I've said to you guys, you know, it's about having knowledge, it's about having understanding, and it's about having a strong mental game. If you have knowledge and understanding, which is what I try to impart to you here, it's what I try to teach to you here, for free, by the way, on these YouTube videos, but of course my subscribers, they get way more information than this, recommendations, etc. But going back to March, when we had all this hysteria about, you know, number one, inflation. I mean, I made a couple of videos saying inflation, the level of inflation is irrelevant to interest rates when you're talking about a country like the United States, which is a sovereign currency issuing country that sets its own interest rate. The central bank is tasked with that. Inflation could be 1,000,000%. If the Fed wants to keep rates at 0, it has unlimited ability to keep rates at 0. And that's just a fact. I mean, you know, you could debate that all you want, but you're going to be wrong. That's just a fact. That's what a monopoly, that's the power of a monopolist. It sets the price. And I kept saying back then two things. All right. Number one, which should have been obvious, was that the Fed kept saying it was not going to raise interest rates. The monopolist was telling you it was not going to raise interest rates. And I did a couple of videos saying how bizarre is it that all of these, you know, Wall Street big shots who for so long have been, you know, repeating and warning us, don't fight the Fed, don't fight the Fed. They were all fighting the Fed and saying, you know, the Fed's going to have to raise interest rates when the Fed was telling them they're not going to raise interest rates. That's number one. Number two, and this is an MMT concept and an MMT understanding. And again, MMT is not policy, folks. All right? It is an understanding of how the monetary system operates. Just like physics is the science of explaining the natural world, you know, the universe, matter. MMT, if you understood it, and I try very hard, again, to impart these concepts and these ideas onto you, the massive additions of reserves into the banking system was going to create downward pressure on interest rates. And by the way, you see it happening in Europe. And I said many times, and I still say many times, that interest rates in the United States are still way too high in comparison to where they are. I mean, the 30-year German Bund is negative. Okay? We still have a positive yield. They have a 30-year, which is negative right now. And we're going down. I keep saying this, and I said it all the way back in March, unless the Fed, for some reason, decides to change its mind and say it's going to raise rates. And then I was saying, with the debt ceiling coming up and the inability of the Treasury to issue bonds, to issue securities, which again is not borrowing, it is a reserve drain. With the inability to drain reserves, you're just going to have pressure on rates to come down. All right. Now this fund that blew out 1.5 billion, which was more than 10% hit that they took, you know, they're in that group of Wall Street people, of financial people who listened to all the nonsense, gibberish, emotional, yeah, I should say that, the highly emotional, hysterical arguments and cries of these, you know-nothing people out there who, by the way, are paraded across the media on CNBC and Fox Business and everywhere else as if they know what they're talking about, who were saying like the Fed's going to have to raise rates, you know, inflation is going to cause rates to go up. I was the only one, maybe not the only one, but I know I do these videos every day. I was telling you that, you know, that is not going to happen. So And all my people were long treasuries, like we went against. So I feel, I'm happy about this, because regardless of what size we trade, we took a little bit of their money. I keep saying to you, like, knowledge, information, understanding, and a strong mental game, you take their money. You take their money. It's mathematical, all right? It has to happen over time with the consistent application of that knowledge and that mental game. So anyway, I'm back and looking forward to what will unfold ahead of us. By the way, I just sent out the new edition of MMT Trader. If you want that, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial. See you tomorrow. Bye.